All right, David, let's get into it. In our last explainer, we left everyone with three different prices for the exact same two-year bond: $826, $756, and $907. Today, we're going to pull back the curtain and actually prove those numbers using the present value formula.
Exactly, and that's the core question, isn't it? I mean, you have to remember, the promise from the bond never changes. It's always $1,000 in 2 years. So logically, the only reason the price you pay today would be different is because the interest rate the market is demanding has changed.
Okay, let's dive into the math. We're going to start with our baseline case. For this, let's just assume the market is looking for a nice, standard 10% return on its money.
You know, the math here is actually a lot more straightforward than you might think. To figure out what a bond is worth today, its present value, you just have to work backward from what it pays you in the future. So we take that guaranteed $1,000 and we discount it for each year we have to wait. We divide by 1.10 for year 1, and then we hit it again, dividing by 1.10 for year 2. And when you run those numbers, you land right at $826. So this is our starting point. That's the price you'd pay today if you wanted to lock in that 10% annual return over the next 2 years.
But of course, markets are never that simple, right? They're always moving. So let's say things heat up. Maybe other investments start looking really good. So investors get a little more demanding. Now they want a higher 15% return before they'll even consider buying this bond.
And here's the crucial part. The formula doesn't change at all. We just swap out the interest rate. So we still start with our $1,000 payout, but now, instead of dividing by 1.10, we're dividing by 1.15, and we do it twice. We're dividing by a bigger number.
So what happens when you divide by a bigger number? Well, the result has to get smaller. The present value, the price you pay right now, it has to sink, and it drops all the way down to $756.
And there's actually a name for this in the finance world. It's called a bond discount. It's a really simple concept. It's just when a bond is trading for less than its future payout, and that happens specifically because market interest rates went up. Okay, so we've seen what happens when rates climb. Now let's flip it. What if the market cools off? Let's say the economy slows down a bit, and now investors are more than happy to get a safer, even if it's lower, return of just 5%. Right. So how does the math handle this? Well, again, the formula stays the same, we just change that one variable. We're still working backwards from $1,000, but this time we divide by 1.05, and then we divide by 1.05 again. As you can see, now we're dividing by a much smaller number. And no surprise here, when you divide by a smaller number, you get a bigger result. The price jumps way up to $907. It makes perfect sense. Investors are willing to pay more money up front because they're okay with getting a smaller return down the road.
Okay, let's just pause here for a second because this table lays it all out perfectly. Let's walk through it. When the market demands a high interest rate, 15%, you get a low price of $756. When we're at our baseline, 10% rate, we get that middle price, $826. And when the market is happy with a low 5% rate, the price is high at $907. You can't deny it. That inverse relationship is crystal clear.
And this right here is that seesaw principle we've been talking about, proven with cold, hard math. It's a perfect inverse relationship. When interest rates out in the market go up, the price of existing bonds gets pushed down. When rates go down, bond prices get pushed up. The math just proved it. And honestly, this is the single most important thing to understand. Through all three of these scenarios, the bond's fundamental promise, that $1,000 payout, it was set in stone. It never moved an inch. The only thing that changed was the return the market was demanding. That is what drives the price. And with that, the puzzle is solved. What seems like this incredibly complex mystery is, when you boil it down, just really straightforward math. Once you understand the simple logic of present value, you really do hold the key, not just to this one bond, but to understanding how and why the entire bond market does what it does.